Welcome back to the Comstock channel. My name is Brianne Hendrickson. Today I have Joe Camp with us. Welcome.
Thanks. Good afternoon. Midweek already here.
I know it's going by quick. I think due to the holiday, I think it just feels like that. Pasture, Rangeland Forage Insurance. Deadline to get coverage is this Friday, December 1st. It is quick and easy to get signed up. You can do so over the phone at 712-227-1110, or you can send an email to report@comstock.com. But the big topic we are talking about today is actually tomorrow, which is first notice day for December. I guess my first question with that is what is the market doing?
Right. Quietly trading here into the close on this Wednesday, the penultimate session before this first notice day, which is also the last day of the month, which we watch closely anytime, whether it's first notice day or not, because of how it can influence position squaring, profit taking, some of the outside markets being a potentially bigger impact on the last day of the month as well. But really rather quiet here. It's corn futures that are off their lows, up by a couple of cents for most of the contracts, except for this December, which we need to get back to as it relates to first notice day and how these December grains are going into expiration. But otherwise, soybeans just fractionally lower here. They had a good day yesterday, but taking a breather here, still just a bit short of $13.50 in that nearby contract. Wheat having a bit of follow through here and a rebound that gives us, some potential hope that a low would be potentially near, as much as that market's been sliding lower here. But yeah, all about first notice day. We'll talk about that. I wanted to give a look first at the December corn chart and show you where we're at as we're heading into the delivery period. And we can see just how sharply we've fallen over these past 4 or 5 sessions. A big down day on Friday, the short holiday session following Thanksgiving, a bigger down day on Monday here, and mostly weakness here this week up to this point. You can see we're poking sharply below that lower Bollinger Band. We like to watch that. And then the other thing I wanted to point out on this chart as it applies to what we're looking at in the coming expiration of the December contracts is that gap that we had here recently in September. And that's when the September contract, September corn futures expired and then left a gap between where the December was trading at a premium. And so that's also what we're going to leave on the charts here when we head into expiration in a couple of weeks for this December contract is an expiration gap because of the way the March is trading above the December. But I bring it back also to note how we recently fell below that expiration low for September corn. So it was a December contract that ultimately came back down to match where the September was at. And we'll wonder if that's a risk too for March futures going forward, if they have to now come back and retrace into that gap and ultimately test this low, which is around 450 for December corn. So some signs of maybe being oversold, but also some concern about what's ahead in terms of this expiration period coming up.
What are you seeing with the December-March spread?
Well, it's about as wide as it's ever been. I mean, we talk about full carry where you calculate the costs of storage, interest, all of that factored in, and we're, by all accounts, already stretched past that, which normally would create some incentive of potential arbitrage, but we're not seeing it. It fits with what we're talking about here with the delivery period coming up. Nobody wants to take delivery of these December corn bushels because of the way our delivery system is structured in such a way that it's all deliverable on the Illinois or the Mississippi River, where the demand's not there right now. I mean, it could be a different story if these contracts were deliverable, say, only to Western Iowa, ethanol plants, but that's not the case. And so it's very much a split between basis is very strong in the West and trying to make up for this discounted futures market. And there's a difference in the East and in the middle of the country, again, where these deliveries take place, where you don't have the incentive. And in part, that's due to relatively weaker export shipments. We have some positive things to say about export sales overall, but that's not helping at the moment, again, when we come into first notice day. So first notice day is the first day that sellers can put out these short December corn contracts for delivery, physical delivery here. And as wide as this spread is between December and March, it's another signal of there not being any demand in the current market. When you have a discounted nearby contract, it's the market saying, we don't need it now, and certainly we don't need it into the delivery system, store it. And there is a carry premium now out to those future contracts. And this comes into play certainly with what is taking place here in terms of traders having to make decisions on what to do with these remaining December corn positions. In part, heavier open interest could suggest that the commercials are staying in and want to try to offer up that delivery because of the board still being over cash values, which is what would incentivize someone to put out delivery. And it can also mean that there were remaining a hefty amount of longs that still needed to do something before tomorrow. And so that was a source of ultimately pressure on the market of a yet weaker December-March spread. It fits too with all of these basis contracts that were still open coming due, and farmers having to make the decisions there on, do you roll into such a wide carry, take a hit? Ultimately, we're seeing some of both, where some are going to roll forward, some are going to take the hit here and price this grain at a relative discount to where we've been over the last several weeks, and then maybe thinking about reownership, say, on the board. A lot of different decisions here, but ultimately this is all mixed into a pretty negative look as we head in to tomorrow.
After first notice day, what do we kind of go back to? Because you kind of say right now we're more technical going into first notice. Does it stay that way, or do we go more towards fundamental?
Yeah, I think the passing of this first notice day can be a source of relief for the market, and ultimately it can get us back to thinking more about the core supply and demand fundamentals. I mean, it's absolutely fundamental when we talk about demand along the river system and basis and all that's going into what we've just talked about. But at the same time, what we've put now on the back burner are these fundamentals like Brazilian weather that can pop up again, about relatedly export demand, about the processing demand and where it's headed here, and its links to the energy market here, where we have some signs of life again for crude oil, and a potentially important day tomorrow too for the energy market when we talk about this next OPEC meeting that's scheduled for Thursday. But back to that first notice day influence, this is something where maybe we could take the page of November soybeans and how they went off the board here just recently. On first notice day, they were down early in that delivery period. There were some deliveries put out, and that was a negative. On first notice day, November soybeans were lower in the morning. They ultimately closed higher, and then from then on, that contract rallied about 85 cents until its expiration a couple of weeks later. And not that you're going to benefit because you won't have December corn longs still in the market, them needing to be closed out today before you have that risk of delivery. But you do have the potential that the December contract can rise from here before it goes off the board in a way that lifts the March contracts and lifts ultimately flat prices for better selling opportunities later. So that's one potentially bullish silver lining for getting first notice day out of the way. And then if we do get back to thinking about these fundamentals, we again bring up Brazilian weather as being maybe the primary topic. And it had been somewhat of a negative last week during the Thanksgiving week. They were scheduled to get some rain, and they did get some spotty showers. I threw up a 7-day precipitation map. This is what Brazil received over the last week. And you can see there's more green and little bits of red where they had some moisture. And that was a big break in the drought that had persisted up to that point. Unfortunately for farmers down there, the outlook seems to shift back to dry and really hot. I mean, we're talking about the beginning of December. Of course, in the southern hemisphere, it's the flip of what we're experiencing now with this onset of cooler temperatures. Well, they're going to have temps that are above 100 degrees consistently, and that's not good for this early crop development. So it can be a good thing though for prices in terms of putting some risk premium back into the market. And then next up will be, can we link this concern about Brazil to maybe eventually, hopefully, better U.S. export demand?
Kind of ending on that export note, let's kind of talk about that and what are you seeing on that side, or what are you wanting to see on that side?
Well, up until about a week ago, week and a half, we were really positive about the ramping up of export sales as we were seeing it both on a daily basis when they flash these morning sales at 8 a.m. every morning. The USDA is going to report if there had been any big grain deals, more than 100,000 tons exported in one contract. And we were getting those popping up often, and then it's somewhat tapered off here. And this week we've only had a couple of cargoes of soybeans sold. That's more routine business, nothing really big to China like we want to see here going forward, and like I think we eventually will. Well, one thing you and I have talked about several times on this is the fact that the dollar's been going lower, and that really helps out and can continue to. It looks like that trend has flipped, and the softer greenback can really help out our export demand. But back to those daily sales announcements, one thing that we can't look past is the case last week, Wednesday, right before we were about to go on holiday. There was a flash sale announcement for some soft red wheat sold to China. And that's good. As poor as wheat exports have been, that's some sign of life here, finally, for that market that could continue. And we think about, as far as wheat prices have come down, the adage there of low prices can be the cure for low prices. And we've restored some value into that market, and exporters are benefiting from relative slightly increasing demand on wheat exports. So we'll see if that continues. But also on that day, along with that wheat sale, was a couple of cargoes sold to an unknown buyer. Now, anytime you see an announcement for an unknown buyer, you think China. And it could be our usual partners, Mexico or Japan, but there had been rumors that that sale was linked to China, and that China is showing more interest in finally buying U.S. corn. And so that's what we want to see going forward. What it could be if we have more Chinese sales announcements, those would be the headlines that I think are seized upon by the bearish speculators. And it's something that could encourage them to start to flip position and turn less bearish and ultimately maybe a little bit friendly this market into the end of the year and into early 2024. That's a real key feature about this market, and why it's been so negative is blame the speculators, right? In this case, it is linked to lower prices that you have the hedge funds holding their biggest bearish bets for more than 2 or 3 years. 2020, the summer of last time they were this short the corn market. The silver lining potentially to a bearish bet held by speculators is that there are a lot of contracts that would have to be covered if they get spooked and start to turn the other direction, and that can sometimes also lead to a large rally, which did occur later in the year after 2020 when they had last held that big net short. So that's what we'll be watching for. And again, if we talk about what would change the mind of the speculators who are currently bearish, in my mind, it's all about exports. And exports are going to be linked to this concern and the continued discussion about weather in Brazil. So those are what we'll be watching for, and wondering if this first notice date tomorrow finally transitions us back to the fundamentals and maybe to something more friendly for this market.
Overall, are you feeling confident going into first day notice, or are you kind of just okay. How are you
Yeah,
feeling about it all?
you can't love the price action. Anytime you're making new lows, it's just not a good thing. And we look at the way the oats look. If oats knows what's going on here, that's not a good thing either for corn. But I do feel like there's some optimism to be had, that it's a matter of patience and wait and see, that if we can get beyond this first notice day, again, if we take the page of where soybeans, how they traded after the November contract went into delivery, all of that makes me feel like, wait just a sec. And if we can get past tomorrow, it might look a whole lot different.
All right, that'll do it for this episode. Thanks so much.
Thanks. We'll see you next time.
Want more premium content? Subscribe to the Comstock Report, where you will receive 2 reports daily. Want more video content? We are on Facebook, YouTube, and now TikTok. So don't forget to like, follow, and subscribe.